Thank you, everyone, for joining DBRS Morningstar's 2021 Credit Outlook Conference. My name is Travis Shaw, and I'm pleased to be moderating today's panel discussion on provincial debt management post-COVID-19. This is the second session in a four-part series this week, and you can find the full lineup on dbrsmorningstar.com. Please note that today's session is being recorded and will be available for replay. So on the next slide, let me set the stage for today's discussion. It's hard to fathom what has changed in the span of 12 short months. The coronavirus pandemic has led to a massive widening of provincial deficits. The economic downturn reduced own source revenues, while governments added health resources to combat the pandemic and unveiled extraordinary spending supports for households and businesses. With a multi-year recovery now on the horizon, how will provincial governments manage ballooning borrowing programs and an ever-growing provincial debt stock? For this discussion, I'm pleased to be joined by two of our largest provincial borrowers, Gadi Mayman, CEO of the Ontario Financing Authority, and Steve Thompson, Executive Director of Capital Markets with the Province of Alberta, as well as Olivier Ruta, Managing Director of Investment Grade Origination at BMO Capital Markets. I'll ask our guests to introduce themselves on screen shortly. And if we could just flip back to the agenda for a moment. Following the introductions, I'll provide a brief recap of our credit rating actions in 2020 and some of the key drivers behind those actions. I'll then share our views on the year ahead and what we'll be watching for as the upcoming budget season unfolds, including the importance of debt and liquidity management as an input and in our assessment of provincial credit. We'll then dive into a discussion with our panelists to get their perspective on how provincial borrowers are going to execute on their enlarged borrowing programs. I'll then wrap with a few unanswered questions that we hope to get addressed in the coming months. And lastly, we'll open up to any questions from the audience. At any time throughout the discussion, please feel free to submit your questions using the Q&A feature at the bottom of your screen. So moving to the next slide. Once again, for those who don't know me, my name is Travis Shaw, and I'm the Senior Vice President of Public Finance at DBRS Morningstar. I've been with DBRS Morningstar since the onset of the last financial crisis in 2008. So this is the second widespread economic downturn that I've experienced while following public finance in Canada. My portfolio includes all provinces as well as one territory, a number of municipalities, hospitals, and universities. And prior to DBRS, I spent a few years with one of our provincial borrowers. So now with that, I'll hand it over to our guest for a brief intro. Let's start with you, Gadi, followed by Steve and Olivier.
Thank you very much, Travis. And that provincial borrower that Travis used to work at is the one where I am now. So I've been at the OFA for quite some time. And prior to that, I had shorter stints at the Toronto Dominion Bank and Export Development Canada. But I have been at the OFA for quite some time and have seen through a number of recessions and changes to what our borrowing strategy and our borrowing needs have been. So I'd like to say that it becomes easier with time. I'm not sure it does.
Thank you, Gadi.
Hi, Steve Thompson. As Travis said, Executive Director of Capital Markets here at the province of Alberta. So I head up the funding team and oversee some of our endowments. Alberta is still blessed to have some financial assets on the balance sheet. So we look after those too. I've been in Alberta now for 8 years, coming up in the summer, and have seen the borrowing program, the debt burden obviously transform over that time fairly significantly. So I've been lucky to be involved in sort of building the place up from the ground up in terms of a debt shop, which of course they didn't need before. But prior to that, I had experience in another province and a little bit of experience in commercial and corporate banking many years ago. But thank you, Travis, for having us. Good to be here.
Good to see you, Stephen. Over to you, Olivier.
Yeah, no, thanks, Travis, and thanks for having me on. Pleasure to be here. As you said, my name is Olivier Ruta, Managing Director In BMO's government finance group, my team and I help underwrite government bonds in the capital markets, so municipal, provincial, federal, and a host of other credits as well. Been with BMO for just over a decade and was with a U.S. dealer that unfortunately no longer exists prior to that. And my time at BMO has been in the government sector, so pleasure to be here.
Right. Well, we are definitely pleased to have everyone here with us, and I think we're going to have an engaging discussion. So with that, I'm going to provide just a few more comments about some of our recent credit actions and a preview to the upcoming year. So we can jump to the next slide, please. And it's quite remarkable. And if someone had told me a year ago that in 12 months I'd be sitting in the comfort of my home debating whether or not to wear pants before moderating a panel discussion for an audience spanning across the country, I would have been dumbfounded, frankly. Nevertheless, here we are, and rest assured I am wearing pants. After the WHO declared a worldwide pandemic on March 11th, it became evident quite quickly that this event was going to have a materially negative fiscal and economic impact on provincial borrowers and all levels of government for that matter. So I remember this day quite clearly as I was on a plane to meet with one of our provincial borrowers at the time. And while the meeting went quite smoothly, as the day wore on and news of more cases and restrictions trickled in, the handshake stopped, and we gradually slinked out of the meeting and raced back to the airport. Within a week following that trip, we took rating action on our 3 resource-intensive provinces. So if we could move to the next slide, please, Jen. These actions stemmed from a rapidly deteriorating global economic conditions and a sharp decline in global oil prices caused by the COVID-19 outbreak, as well as actions by OPEC Plus to recapture market share. With Alberta already on a pre-existing negative trend, we downgraded the long and short-term ratings to AA low and R1 middle respectively. The negative trend on the long-term ratings was maintained where it remains today. For both Newfoundland and Saskatchewan, we placed their ratings under review with negative implications, while we took time to assess the full impact of the rapidly unfolding events and each government's response on their overall credit profile. We followed this up in mid-June by placing Newfoundland's long-term ratings on a negative trend and removing the under review status. And we downgraded Saskatchewan's long and short-term ratings to AA low and R1 middle. For all other provinces, we've confirmed their ratings throughout the course of the year. And these confirmations have largely reflected the fact that in many cases, provincial governments had been making progress to address fiscal imbalances, in some cases running meaningful surpluses, slow debt growth, and had been enjoying favorable economic conditions prior to the pandemic. While we anticipated the pandemic would lead to a material widening of fiscal deficits and a step up in provincial debt, it has been our view that given the nature of this pandemic, we would see a fairly robust recovery in economic activity and in provincial finances. Moving to the next slide. As a reminder for our audience, our provincial and territorial government methodology focuses on a combination of qualitative and quantitative risk factors. While some of the financial risk factors oscillate significantly in times of stress, there is a degree of stickiness to many of our critical rating factors. For today's discussion, we're going to focus on debt and liquidity management. This has been a critically important factor that has contributed to provinces' ability to navigate through this pandemic. And for more information on these factors, I'd encourage you to review our provincial methodology on our website. And you can search for our provincial scorecard, which summarizes our assessment of these various factors across provinces. We just published an update on Monday. Moving to the next slide, as we look ahead to 2021, we'll be earnestly looking for evidence of the economic recovery, which we expect to be choppy if the first few weeks of 2021 are any indication. Current projections point to real GDP growth ranging from about 3.5% to more than 5% across provinces. We do expect that there will continue to be a need for governments to support households and businesses while the recovery is ongoing. Many provinces established large contingencies in their budgets and fiscal updates last year, which we believe provides a degree of flexibility to do so without having to necessarily go back to the well. We should begin to see budget updates in the coming weeks and months that will chart a path back to balance, or at least lay out a roadmap of the direction they're headed. For the resource-intensive provinces, the damage inflicted on the energy sector is likely to be long-lasting, compounded by a longer-term transition away from fossil fuels to more sustainable sources of energy. For more on this, I encourage you to tune into tomorrow's session on the Canadian oil and gas sector outlook. As such, revenues in these provinces are unlikely to rebound as quickly, and there will be tougher fiscal choices to make if they are to be successful at slowing debt growth. We continue to have 2 of these provinces on a negative trend, and we'll be looking for clues as to how they'll manage their challenges in the months ahead. For most others, while flexibility within existing ratings has been reduced, we do expect that a more robust recovery in provincial revenues and more concerted efforts to slow debt growth will help to mitigate the ratings impact for these jurisdictions. Now with that, I'd like to get started with our panel discussion. So once again, welcome Gadi, Steve, and Olivier. We are pleased that you could join us today. And for a little context for our audience, in light of the fact that most provinces are in the midst of budget preparations, I'll largely focus my questions on debt management. While we don't know the full magnitude of debt growth over the medium term, I think we'll have that answered shortly. We do know that it will be persistent, and you'll all have your hands full with the execution of larger borrowing programs for the foreseeable future. So to get started, I don't want to dwell on the past. I think it's useful to look at some of the events that transpired over the course of the last year. So my first question for our guests is, can you provide a brief overview of how you managed debt programs throughout the spring of 2020 and how instrumental the Bank of Canada was in restoring confidence in supporting the smooth functioning of the debt markets here in Canada? So maybe to get started, Gadi, as the individual responsible for the largest provincial borrowing program, I'll turn it over to you.
Well, thank you for that, Travis, and thank you for the introduction. And let me start by saying we started a little bit later than everyone else because of the way our budget cycle operates. We were preparing for a budget for last March 25th, and we had actually put it pretty much together. And the then Minister of Finance, Mr. Phillips, had what has become a tradition that I think will be broken this year. I know will be broken this year, of appearing at one of the clubs in downtown Toronto, the Economic Club, the Canadian Club, one of those for lunch, and to give first of all what the date was going to be of the budget, and also to give a few little tidbits away as to what was coming. So that had happened in early March. Minister Phillips then returned to the office and kind of said, I'm not sure that this works. And this was it was a lovely budget. We were on track for the path that we had. We were actually a couple $2 billion ahead. We would have balanced by 23-24. All great. But that's when COVID was picking up in Canada, and it just didn't make sense. So we pulled back, and through this whole time, and the reason this ties in with what you're talking about in the spring, we were blacked out from the market because, first of all, we had prepared a budget that was, and then we were then in the process of in a 2 or 3 week period preparing what became the fiscal and economic update, their economic and fiscal update. So we were blacked out of the market, and we watched with a degree of shock, horror. I don't know how I'd put it, to see how the provincial market was falling apart. It was in really, really difficult shape. I would say in some ways more difficult shape than I've seen in my entire career. And we were watching our fellow provinces as having to do things that they had not had to do before, that none of us had had to do before, in order to be able to get money in the door. And it was kind of frightening sitting on the sidelines. And so we were planning to, okay, what are we going to do when we come back in? What are we going to do when we come back in? The good news is that by being a little bit late, to the, I won't call it a party because it wasn't much of a party, it allowed the Bank of Canada to start to take some actions. And those actions then smooth things over quite considerably. The first thing that they did was on the money market side. And normally we don't worry about money markets. Even during the global financial crisis, one thing that we could always count on is every Wednesday morning when we went to do our treasury bill auction, people would show up. We would get good auctions done. We would get in the money we wanted. That market started to freeze up. And that really scared us. So the Bank of Canada came in with what was called the PMMP, the Provincial Money Market Program, where they bought up to 40% on top of whatever we issued. So we issue just over $1 billion a week in Treasury bills. We auction just over $1 billion a week in Treasury bills. So they would add 400 million on top of that. 420 to be exactly was $1.05 billion. This worked so well that not only did the market come back and our spreads went from being 75 to 100 basis points over Canada to pretty much flat to Canada, that the bank was able to ease off on that. So a really, truly successful program, which no longer exists and hasn't existed for, I guess, it's a couple of months now. And yet we're still, we did a treasury bill auction this morning that went just as successfully as all the others again. And ranging from flat to a couple of basis points or maybe even a couple of basis points through in one term through where Canada treasury bills are. The bond market, it took longer for the Bank of Canada to be able to weigh in on that. And how they have weighed in is, I would say, in terms of quantities and in terms of what they actually do is much less meaningful. But in terms of restoring order in the marketplace, it's been incredibly successful. So we now see our spreads back to where they were or through where they were back in February. Now, I often say that's a little bit misleading because a spread of 60 basis points over a 75 basis point Government of Canada bond is a lot different than a 60 basis point spread over a 2% Government of Canada bond in terms of proportion. But still, though, there is access. So the Provincial Bond Purchase Program, which is still in place, was put in place last May, is scheduled to last until this May. Buys a small amount of bonds. And I want to put this into perspective. The Bank of Canada's real role, other than stabilizing the market, which they did incredibly successfully, and it has been on the Government of Canada side. And so we see that in terms of the amount of debt that's outstanding, in the Bank of Canada, the last numbers I saw owned about 1% of provincial debt, whereas they own almost 30% of Canada debt. And probably more meaningfully, in terms of how much of the issuance that has taken place this year, they've purchased about 7% of provincial debt as compared to almost 80% of Government of Canada debt. So what they've really accomplished through that is by stabilizing the Government of Canada market, which is the basis upon which we all operate, it's provided the stability that we've needed that's enabled us to go out and borrow pretty effectively and actually we've already completed our borrowing program for this year and we started pre-funding for next year. So a lot of credit to the Bank of Canada for just providing an incredible degree of stability in the marketplace.
Great. Thank you, Gadi. Steve, maybe if you could give us Alberta's perspective.
Yeah.
In a slightly different position at the time, having already issued a budget prior to the pandemic, but how did you find funding in the market and any additional comments to add?
No, I would echo Gadi's comments wholeheartedly. We were in a very similar position, actually, where a budget had been prepared prior to the impacts of the pandemic really being known. And we were left with what was not a realistic budget in terms of the, certainly on the revenue side, and in terms of a lot of the things that were on the expenditure side. But government made the decision to go ahead and table the budget and pass it, mainly to put the authorities in place, to put a spending plan in place. So this government is very focused on the expenditure side of the equation, on bringing Alberta's expenses in line with other large provinces like Ontario, Quebec on a per capita basis. And the signaling that was important to government at the time was that they weren't going to deviate from that plan. Yes, we were in an unusual set of circumstances and there would be extraordinary expenditure and extraordinary impacts because of the pandemic, but they didn't want to get away from their core message. And it was very useful for us in the debt shop because it put all of our borrowing authorities in place. So it meant that we could run our program unencumbered and, do what we needed to do. Just picking up on some of Gadi's comments, the the fact that you could come in and you weren't sure that you could get all of your money market funding done is horrifying on this side of the street. That is where we go when we most, need cash. Now, luckily, we do carry a large liquid reserve, so we did have a lot of cash on hand. We always have about 3 months worth of cash on hand, plus another reserve on top of that usually equates to another 3. So, we do have a lot of cash in the bank, but even that's not flowing very well when the whole market is locked up. We were able early on to access the term debt market in Canada, but in ways that we normally don't like to. What we have spent a lot of time over the last 5-6 years on is, establishing liquid benchmarks in Canada for Alberta. And to do that, we have stayed away from, non-benchmark terms. We've stayed away from MTN issuance and private placements. So early on, to bring cash in the door, we loosened those restrictions on ourselves. And, in partnership, honestly, with some of our largest investors, I managed to print some private placements onto our issues, which we don't normally like to do. But it worked for everybody. It allowed the investor to get some product that they wanted, and it allowed us to get cash in the door that, we wouldn't have been able to otherwise. It wouldn't have been responsible for us to be issuing a proper public benchmark at the time, because we knew it wouldn't sell, and we knew that it would just drag down the whole curve. So we did what we had to do. The money market purchase program from the Bank of Canada, was a spectacular success from our perspective. We never actually accessed any of the funding they made available, but simply the announcement, their willingness to act, their responsiveness, and I can tell you the bilateral conversations and the multilateral conversations that we had as issuers with the Bank of Canada on what we needed. I found them very responsive and, very engaged, and they were really valuable partners in that. We didn't feel like we were on our own, and I think they felt the same way with us. So it's how do we get this market moving again? So those headlines were probably more important to us than the actual programs, because our program, although large, is not as large as Gaddy's. So it's it's a little incremental from our perspective, but it wouldn't have been open but for the Bank of Canada. And so, yeah, full props to them on the money market program early on. And, to Guy's point, the bond purchase program, we pay a little bit of attention to what lines they may or may not be buying, but we haven't seen a significant impact on our secondary flows. It certainly hasn't changed our decisions around sort of what term funding we're looking at. But definitely interesting times. And now, we find ourselves back to basically a fully functioning market. It all sounds as a bit glib, and it happened very quickly. It did not. It was a slow grind. There were a lot of long nights. There were a lot of sleepless nights. We all figured out how to work remotely. I'm blessed actually to be back in the office myself, but with about 10% of my staff. So interesting times on that. And yeah, we've got a budget coming up soon, so we'll have some more numbers for you, but and they'll be much more realistic than you saw in the last year.
All right. Well, thank you for that background, Steve, and we'll definitely we'll stay tuned for the budget for sure. Olivier, I know we spoke a number of times throughout the spring. Could you perhaps give us a little color on what types of investors were active and those who maybe had to sit on the sidelines?
Yeah, for sure. First off, I'd echo my panelist comments. Having lived through the 08-09 global financial crisis, I think this crisis kind of hit, and it surprised everyone with how quickly it hit and how large it hit, the financial markets. And I do echo the comments made by Gaddy and Steve that the Bank of Canada was instrumental in restoring confidence in the market. In addition to the provincial money market purchase program, I think the BA purchase facility was very useful to take pressure off of bank and dealer balance sheets. And even though the provincial bond purchase program has not been utilized to that great of an extent, it has helped absorb some of the net incremental supply and has kept dealer inventory at a manageable level and is kind of seen as a backstop. So kudos to the Bank of Canada for helping restore confidence. And yeah, the types of investors, I mean, just given the volatility that we were seeing, the liquidity drying up first in the money market space, but that obviously translated into to a little bit of liquidity challenges in the term bond market, especially in provincial bonds. Sometimes it was very hard to call a market. So to Steve's point, they did private placements. Private placements became the norm. And I think that was as a result of some of the smaller players, smaller investors, really just sitting on the sidelines waiting for markets to calm down. And really, we saw some larger investors kind of stepping up, providing some sizable reverse inquiry interest to dealers that were providing liquidity. So, we saw carve out interest from the larger players in Canada. The bank treasuries were active. So some that had liquidity to go, which is why you saw a lot of shorter tenor private placements, 3 to 7 years, which is kind of the sweet spot. You saw some of the pension plans that had excess liquidity, and that saw attractive spreads. Even though it was tough to call when the widening would stop. Obviously, historically, these spreads were quite attractive for some. So for some that were able to take advantage, we saw them active. Obviously real money fund managers, some of the larger ones that had excess liquidity were able to tap into these private placements, and they kind of became the norm. And to Steve's point, for well over a month and a half, private placements became the norm. It was kind of hard to see a time when we would be able to get back to the normal way of underwriting provincial bonds. And the culmination of it was April 14th, when we saw 6 provinces tap the market for $8.25 billion in one day. A lot of it via carve-outs. I don't know if we'll ever see that kind of day. And ever since then, markets have been kind of slowly functioning a little bit better. And to Steve's point, we are kind of back to the normal way of underwriting bonds. But I would say it was the larger investors that kind of drove a lot of the private placements for that chunky size.
All right. Thank you, Olivier. That's some other additional great color. Maybe with that, we can segue just into a discussion about just market access generally, and not just within Canada, but abroad as well. We look at an issuer's ability to access markets, in different markets, as obviously a very important feature of their debt management programs. So, Stephen, maybe I'll start with you on this one. Could you just give us a little color about, how do you ensure you maintain access to various markets, and how do you identify new markets that might be worth pursuing?
Sure. No, happy to. And like you say, it's been critical to us over the past few years because, Alberta, uniquely amongst provinces, you'll laugh at me for saying it, but has basically grown from a zero debt issuer to a fairly significant debtor. So we've been kind of lucky to have been growing our debt stock in a low rate environment. And when I joined 8 years ago, we didn't do a lot offshore. They would do an occasional US dollar deal on their docks. So what we as a group sat down and decided, as you could see what was going to happen. I mean, we didn't predict the exact future, but we knew that Alberta's debt stock would grow. Some of it was on capital spending, and a lot of it would be on energy industry future. We knew that we couldn't do the whole program inside of Canada. So we set up, the first thing you do is set up a platform. So globally, an SEC registered global platform for dollars. Outside of Canada, US dollars is a huge market for us. I would call it a core component of our borrowing program now. I don't view it really as an arbitrage platform. I mean, we do obviously look at pricing around specific trades, but we want access to that market at all times. So we will always keep that platform updated, and then we have an Australian dollar platform and an EMTN shelf. So you need those fundamental platforms to access the markets, but that's not how you sell bonds. You sell bonds to investors, and investors are people. And so we reach out to global investors. Sometimes interest comes to us through existing networks. But we spent an awful lot of time on investor relations over the past 5 or 6 years. Obviously, a different dynamic this year as we all move to these virtual platforms. And really, it's about listening and seeing what the largest investors of the particular market want in terms of tenor, in terms of structure, in terms of liquidity and frequency, and then tailoring your program to that. And what we've typically found is, on dollars and euros, we see larger investors. Central banks are generally our first foray into any market. Large national pension funds, and then you have various sovereign wealth funds, and down the chain to investment managers and asset managers. So we spend a lot of time just talking and seeing what works best for them. And we have to plug it into the context of our program. So fundamentally, we price ourselves in Canada. We know what our cost of funds across the curve is there. And we kind of take that out and market it to whichever investors are interested. And we target about 40% of the program to foreign markets. And, well, in foreign currency, I should say. It's not always in foreign markets, but for the past 3 years, it's sort of been north of 50% as the programs have been larger. So yeah, I sort of wandered off your question there, but it's about maintaining access. It's about with these larger ones, particularly central banks and the pension funds. They do like to know that you're not sort of one and done. What we found on our program was, when Alberta was an infrequent issuer in foreign currency spaces, chasing arbitrage, we didn't have great relationships with these investors. But when you have a large borrowing program, our program this year is of 30 billion, or it's been averaging between 15 and 20 billion for the past few years. When you have a program that size, they know you'll be back. And if they're happy with the performance of your bonds over time, that's obviously the start of a relationship. And once you set that sort of performance for them, then more investors will come to you. That's really how we've built it.
All right. Well, thank you, Steve. I know it's been interesting to watch Alberta's foray into the debt markets from really not that long ago, and it's been quite a pretty rapid transition, and I think successful so far. So.
Thanks for that. It's been fun to watch from here too.
I bet. Gaddy, maybe for a bit of a different perspective, I know you've got a pretty extensive investor relations team at the OFA. Have been quite active for a long time now. Maybe just give us a little color on anything you have to add, and maybe how it's been even different in this environment, despite having a pretty active international investor base.
Well, we've had an active investor base, but it's one that we've had to expand as the borrowing program has expanded, and we actually find ourselves in a bit of a sweet spot. We need access to, and we need investors to buy our bonds, the same ones that Steve had talked about. What we provide is liquidity. And so investors know that in times of turmoil, our bonds are ones that they're going to be able to transact in and get in and out of. And that's really important. Even if they plan on holding it for a long period of time, everybody comes in with a need for an exit strategy. And so, they'll look, is Ontario a regular player? Yes, it is. Does it have large size issues? Yes, it does. Is it across the curve? Yes, it is. So does that mean, is there a big investor or investment dealer group that will provide secondary trading on these bonds? Yes, there are. So that's been important for us to develop and maintain the network, both of investment dealers that underwrite our bonds and trade our bonds in the secondary market. To continue we've established relationships with investors, but to continue to develop those even more and more. And that's harder to do at a point in time when you can't actually go and visit them. And so we have actually gone more and more to social media, which if you'd asked me a year ago, I would have said, well, that's insane. But we use the OFA has a LinkedIn site, a Twitter site. I have a LinkedIn site. And the purpose of that is not for me to go out and do a video, which I actually don't particularly enjoy doing, but just to try to draw people to our website, because that's the other thing that we have. We have a very well-established and we've gotten a lot of feedback that it's a very informative website. And so to try to just remind people that it's there. And so to try to drive through that. And I guess the measure of success of it is that in January, we borrowed $12.6 billion, which is the largest month that we've ever had. And we were able to do that because we did have access to investors, and investors were interested in buying our bonds. And that's been really, really critical for us. And that's at the forefront of our thought process. So that's how we try to access both international markets and domestic markets. In domestic markets, I am not for a moment going to be complacent about domestic markets, and I'm not going to say, oh well, everybody knows who Ontario is, and so they're going to buy our bonds. Well, that's not necessarily the case. We have to be able to provide value for them. We have to be able to provide stability for them. We have to have a plan, and so we try to facilitate that and be as transparent as we can.
Great. Thank you, Gadi. And we certainly appreciate the video content. I think everyone's trying to do more of it, and I think it's you're doing a great job so far. So keep it up. On that note, and I'll just remind our audience again, if you do have any questions, certainly feel free to submit them as we go. I know we've got a couple now, and one relates to one of my questions I had planned to ask our guests. So I'm going to jump to that now because I'm encouraged to see that there is some interest in this. And it's certainly a question we've been getting more and more of late, as I'm sure all of you are. So ESG is increasingly important for the financial community as a whole, certainly for investors, regulators, and rating agencies alike. And I think this is a fact probably made only more important by the recent change in administration in the U.S. So, Olivia, maybe if we could start with you, just to get your take on, how discerning are investors when evaluating ESG considerations when it comes to provincial bonds?
Yeah, no, I think it's quite important for investors or green investors. ESG considerations when evaluating provinces and what green bonds to invest in. Use of proceeds is definitely important to investors with ESG mandates, especially those that have specific mandates or funds set aside to invest in these securities. And if you're a signatory to the UNPRI, you have certain investment criteria to kind of uphold when investing along those guidelines. Initially some investors were even passing, when the Canadian dollar green bond market first kicked off in 2014, 2015, we saw some investors even passing on some offerings because they didn't really fully agree with the projects that were being funded and with the greenness of the projects being funded, because it's sometimes subjective. There are market standards, but there aren't, concrete guidelines, even though obviously the green bond principles and taxonomies help with that. One example is a project that was funding an expansion of rapid bus transit. I won't name names or anything, but obviously, green, taking cars off the road, but because of the types of buses that were along the route, not being electric or not, the investor that we were talking to ended up passing. So there was definitely scrutiny. We get asked for investor presentations around green offerings quite often from green and social investors, wanting to see the kind of projects, again, to evaluate the greenness. But I would say perhaps a bit less scrutiny in the last couple of years from investors, especially with repeat issuers like Ontario, as they've kind of built somewhat of a trust factor with investors. A lot of the similar types of projects are being funded, and the impact reporting that a lot of issuers have been doing over recent years has definitely helped ease investor concerns over the greenness of the project. So I would say that it's definitely important. We get a lot of questions around it, but maybe less so than when the market initially started in 2014.
All right. Thank you, Olivier. Maybe just continuing on the topic of green bonds specifically, I'll turn it over to Gadi. And Gadi, with Ontario having been really a pioneer in the green bond market here in Canada, could you a question we often get, and maybe just appreciate your thoughts on, and I think this ties into some of Olivier's comments. To what extent are these green bonds, truly funding incremental environmental benefits? We'll say.
Well, I think it's really important to say that we are really reticent to segregate bonds. This is the only segregated bond program we have. Everything else is a general obligation of the province of Ontario. We started this program in 2014. And since we've started it, we've been asked whether we would do social bonds, other types of bonds, and we've really stuck to this one aspect. And it is an issue for our times, and it's an issue where investors are quite interested. And so when we first started the green bond program in 2014, 2015, it wasn't quite as formalized a market as it is now. And there were a lot of investors, okay, yeah, it's an Ontario bond. I'm interested in that term. I'll buy it. We've now gotten to the point where many investors actually have at least a certain portion of their portfolio. They have demands from the people that they invest on behalf to actually have something that's designated as green or as social or whatever it is. And they're willing to pay for that. So the same way as, I don't know what a good example is. If you buy a fridge that has a freezer on top or a freezer on the side, maybe it's worth more than a fridge that doesn't have a freezer. And so people are willing to pay a little bit more for that. They're now investors, because they're getting an extra feature, are willing to pay a little bit more. Very little, but but it is there for green bonds. So and so we see what is referred to in the marketplace as a greenium. So we issue at slightly lower rates to fund these projects. So does that get extra projects? I don't know if it gets extra projects, but what it does is it makes those projects more affordable, and so we go forward in doing that. And there's a broad spectrum of projects that can be financed under our green bond framework, and so the most obvious one is public transit, and I think Olivier talked about bus rapid transit. With us, it's mainly subways and GO Transit, our regional transit network. But we've also financed buildings. So, for example, three of our green bonds provided financing for about a third of the total cost of a hospital just northwest of the city of Toronto, the Cortellucci Vaughan Hospital in a suburb of Toronto. And the reason I raise that is that hospital just opened. It was supposed to open as a general use hospital. It's actually been designated by the government to be COVID specific for the next period of time. So so you might say, well, how does that tie in with green? Well, the reason it ties in with green is that it was LEED's Gold. I think it was the level it was. So it's using less energy than earlier hospitals would have. And it's a coincidence that it happens to be used for something, but there is something that I think both investors and those of us who are issuing the bonds have a bit of a good feeling about, in that we're providing something that is actually of use. And one of the things that we really haven't talked about in the 45 minutes we've been talking about is that what we're dealing with now, what makes it really different from all of the other recessions and financial crises that I've dealt with in my career, is this is a health crisis, right? This is something where people's lives matter, and saving people's lives. So I'm moving away from your question, so I'll stop talking because I know there's a lot of other things that you want to talk about. But these are the sort of interconnectivities that actually make what we do feel very valuable and important.
Right. Thank you, Gadi. And that's definitely great context. We appreciate that. and maybe with that, I'm going to turn it over to Stephen now. And I know Alberta's been in the headlines on the ESG front and certainly gets a lot of attention. So I'd like to get your thoughts, Stephen, just on what you're hearing from investors and to what extent does Alberta have a space in ESG oriented portfolios?
Sure, and that's a fair question. And I always come on these sorts of panels, and people expect me one day to announce our green bond platform. Today's not the day, but I talked a bit about the amount of investor work that we've done over the past few years, and it's been very extensive. And I would say over the last 2.5 years, I haven't had a single meeting with investors where ESG is not a topic. To Gaddy's point, we focus on what that means for the debt portfolio, on what that means for raising funds. There's broader policy issues, being a large energy producing region, and trying to be supportive of the energy industry and its transformation and its move to more less carbon intensive production, and you have our industry moving to net zero over time, under their own volition, but in a policy environment that we create. But again, moving away from your question, but we've looked at it and said, where would the sustainability bond or transition bond? I don't think you'll see a green bond out of Alberta because the signaling is a little confusing. But as the entire space has matured and as the market's matured, and Gaddy's talked about there being an incremental financial benefit as a funder to being in that space, and I know Quebec's had the same experience on their green programs. We look at it and say, well, could something exist in the transition space that would bring us either incremental funding or cheaper funding? And I agree with Gaddy. I don't like ring fencing funding. I don't like segregating funding or segregating bonds. The most success we've had in reducing our costs, in keeping our bonds liquid and trading, is simplifying the program in Canada. Sticking with benchmarks, not muddying the waters. And my fear early on with green platforms and with ESG broadly in terms of issuance was that it did just that. It increased costs, oversight. It diverted the attention away from the actual cost of funds and from the liquidity of the bonds to other issues that don't belong in the debt shop. I mean, I should not be making any sort of moral or program decisions here, other than funding the place. But what we've seen is investors are keen. They've carved off separate piles of money that are, to be directed to these initiatives because that's how much they believe in them. So I do believe that there's a space there for us. In terms of have we been blocked out? To my knowledge, we've had one investor out of Sweden. You can figure it out from there. Who has divested themselves of Alberta bonds. Obviously we see things in the energy industry. They haven't bled into us as a government. I don't think they will. I don't think they should. As much as revenues come from the energy sector in Alberta, the services that we provide to our people, the impact that we have on their lives, and the requirements for cash are the same as those in Ontario and those in Quebec. We're culturally a little different out here, but that's just life. So I think there is a place for us at the table. I don't think you can actually have honest conversations about green in Canada without including Alberta. But I haven't found it to be a limiting factor when it comes to investors. It certainly impacted pricing. It's certainly impacted the conversations we have. And as investors hold more and more of our bonds, they get more and more of a say on what things matter to us. That's just, that's their prerogative. But we haven't seen a dramatic impact on our funding programs, I have to say. But we're open-minded. If the right thing if the right program is there, we will service it. And we will do it. I don't want to do it disingenuously. I don't want it to be a green bond issuer because everybody else is. I want it to be because it either saves us money, gives us access to investor capital that we wouldn't otherwise, or allows government to accomplish something that it couldn't with run-of-the-mill vanilla funding.
All right. Well, thank you.
I just want to weigh in here a little bit, and I think that the points that Steve makes are really, really important. And the only, a small area of divergence that I might have with him is that you talk, Steve, about not wanting to set policy within the debt shop, but policy comes down to money in a lot of cases. So I don't think that we can avoid it when we're in the Ministry of Finance to be involved on the policy side. And the policy objective here is it's to save some money and to get funding for these projects. But the real policy objective under here is to reduce carbon emissions. And so I think there are real opportunities for resource-intensive provinces like Alberta to use this to help transition to something. And Alberta has, you said you're culturally different. I think a lot of that is quite frankly the way the media makes it out to be. There's a whole lot more similarities than differences, and I think that there are a lot of really interesting things going on in Alberta right now in terms of green, and that gets obliterated by the headlines about Keystone XL or whatever it is, and nasty names about certain resources. But if something that Alberta does can reduce GHGs by a certain proportion, why wouldn't investors be interested in funding that? So I think it's a really open space, and I think there's a real opportunity for things to take place there. So I just wanted to sort of close that circle a little bit.
No, look, I completely agree with you, and I do. I guess my point is more. I see the green side in the debt shop as a policy tool rather than it originating with me. Implementation, execution, and getting things done. But nobody voted for me to be here. They voted for the government to be here. And if government is going in that direction, we will use all the available tools to take them where they need to go. But yeah, totally agree with you.
All right, well, definitely thank you both for the additional context. I think that's great. And again, I'll remind our audience, we have another panel tomorrow on specifically focused on with the oil and gas sector and the transition to greener energy sources. So certainly, I wish we had more time. We could probably spend a whole panel on this topic alone. But in the interest of time, we just have a few moments left. So I'm not going to be able to get up to all the questions, but any we don't have, we can follow up with those folks afterwards. But first, one of the questions we've got here is, and I think it's totally fair. So I'm going to put this to you, Olivier, just to avoid putting Steve and Gaddy in maybe an awkward position. But they ask, what can we expect to see in some of the upcoming provincial budgets? I'm particularly interested in the path and pace back to fiscal recovery. Is that full balance, or is it something a little different? I know both Alberta has articulated some fiscal anchors already, and Ontario has indicated that we'll be getting some more guidance in the upcoming budget, I believe. But Olivier, maybe if you could share your thoughts on what you're expecting in the months ahead.
So you're going to put me in an awkward position then, Travis. It's fine. No, it's a fair question. And I know that Steve and Gaddy probably can't opine too much, but, we're not, and I don't think investors are expecting provinces to get out of deficits, too drastically. Because, let's be honest, we're not really out of this pandemic quite yet. The second wave is around, third wave, whatever you call it, the variants. We're still working from home. We're still under lockdown. And the lockdown hopefully doesn't continue for too long. But economic activity, even though there's been some upside on GDP growth, and us at BMO have upgraded our calls for Q4 2020 GDP, Q1 and 2021 GDPs, as has the Bank of Canada. So there is some optimism that economic growth will rebound more than it has, because the second wave has not impacted the Canadian economy as much as some would have thought. No, I do think that provinces are going to be prudent and maybe under promise, over deliver, as investors like to see from provinces, and potentially maintain some pandemic level spending, for the next year or two, just to ensure that we do get out of this pandemic and that we can get back to normal. So, I don't think I don't think investors are expecting provinces to get back to balance this year. But I do think some upside is probably baked in, and probably a good reason why provincial credit spreads are continuing to tighten and maintain these tights that we haven't seen since even before the 08 or 09 financial crisis.
Great. Thank you, Olivier, for that. And I don't want to exclude Steve and Gaddy. If either of you want to opine on that, please feel free.
Just really quickly, because I know we don't have much time. We're in a different world than we were a year ago, and if we were throwing around numbers like this a year ago, investors would, I'm sure, be treating us very differently, as would you as a rating agency. But in the go forward, Olivier, you're right. We're not going to balance next year. I'm not giving away any secrets on that one, but. What we will be looking at is a couple of things, a whole variety of things, but two I just want to point out. One is the affordability of the debt. And so the debt to GDP ratio is a really, really, really important number, and we'll always focus on that. But debt to GDP ratio means a whole lot different things in a 5% interest world than it does in a 1% interest world. So that's one. So affordability of debt. How much of our of the very valuable taxpayer dollars that come in the door are wasted on interest. And I hate to say wasted, because all most of the people in the audience here, that's where they make money. But from a government perspective, that's money that's not going to provide goods or services to the people of the province. So that's one aspect we're going to look at. And the other aspect that the government is going to be really focusing on is the debt to GDP ratio is a ratio. The primary focus in the past has been on the debt side. I think there's going to be way more emphasis on the growth side, and on the GDP side, on the denominator. And the more that denominator can grow, and the faster that can grow, and lessons that can be learned from the changes in the way that we're going to operate as a society coming out of COVID, and where we can move GDP forward, will help us move that path back down too.
All right, thank you, Gaddy. Steve, in the interest of time, I'll give you 30 seconds if you have any comments to add.
No, I mean, we're in the same boat as Gaddy in terms of, debt to GDP is important. Debt affordability is a conversation we'll always have. I will say, this government remains very focused on the expenditure side of the equation. And obviously, we're not going to balance next year either. There is a commitment by this government to eventually get back to balance. And I think you will see a bit of that detail in the upcoming budget, if not all. I don't know. I haven't seen it. But it is very important to this government to return to balance as soon as possible, and to do it as much through expenditure control as possible. That does not preclude revenue initiatives down the road, but there has been no talk of them in the near future.
All right. Well, thank you very much, Stephen. And we will certainly be watching with a keen eye as we move forward. And in the interest of time, I'm hoping we don't get cut off, but I just wanted to say thank you to all of you for joining us for an engaging discussion. Gaddy, Stephen, Olivier, it's been a pleasure. And we'll certainly look forward to having more discussion in the weeks and months ahead. And thanks again to our audience for joining. Any questions we didn't get to, we'll be sure to follow up with afterwards. All right. Stay safe, everyone, and take care.